Now, and Ali, I love it when you come and talk business with us, especially when it's these fun catchphrases like yield curve inversion.
You know,
enlighten everyone if you
we
would.
don't go out of our way as business reporters to say things like that to people, right? That's the kind of stuff that typically would bore someone, but it's really important. The yield curve is a signal that a recession could be coming, and the way we look at that is over the last 60 years, one has preceded every recession. Right. So it's not a precondition for a recession, but it's a sign. Now look at those red bars. Those are recessions. The yield curve is the chart. Look at the fact that it dips before every recession. Sometimes it's 10, 12, 18, 20 months before the recession, but it's a signal. The short explanation is that there's no payback for investing in bonds right now. So many people want to get out of the stock market into bonds that the interest rate you get for doing that is low. It's a signal that there's a lot of fear. People are leaving the stock market.
Look, I think all you need to say to people is the last time that we saw a yield curve inversion was 2007.
Right,
and they
before
know
the recession.
They know what that means. When we say, though, let's just say for argument's sake the yield curve is correct and it is indicating a recession. That doesn't mean tomorrow that we're in trouble.
No, in fact, the average is about 22 months.
Okay.
Now, here's the problem. We're 10 years and I don't know how many months into an expansion.
Right.
The longest one we've had in the last 50 years was 10 years and 6 months, right before it was in the 90s. So we're due for a recession anyway, so suggesting that there might be one coming in 18 to 20 months is not in and of itself unusual. It's everything else that's going on. The trade war, the pressure on the markets, the pressures on interest rates that the president wants them lowered. It's messy, and investors don't like messy. So when you combine messy with falling interest rates, with this yield curve inversion, with the fact that people don't know what the policy is going to look like with China, you put that all together, people say, I'm going to invest in bonds, not stocks. They're less risky.
You know, Ali, it's so easy for us to forget, too. I mean, what, a year or so, people were talking about maybe we'd see a recession at the end of 2019 already.
Yes.
So we love to have a short-term memory about these things.
Right.
Are there, though, indications that maybe the yield curve could be completely wrong? Because, you know, a lot of people will say, well, our economy looks pretty good in spite of all of those global issues.
So we're already in a slowdown of sorts, right?
Okay.
We're growing. We're just not growing as fast as we were. So the yield curve's probably not wrong in that there'll be a slowdown. The big question, and it was reborn again in 2008, is how bad does a recession have to be? It can be just a little recession. The stock market can go down. You know, there are things that happen that are not good for anybody in a recession, but you can have a short one that's shallow, as we say, as opposed to the last one, which was long and it was deep. So that's what worries people. These things can be self-fulfilling, right? The Dow's down 800 points today. That's 3%. That's the biggest percentage loss of the year. That starts to happen, then people start to say, wow, there's a slowdown coming. So companies choose not to spend as much. People choose not to spend as much. It all feeds on itself. It's psychological. It's not scientific.
Now, I want to touch on something the president tweeted today. He came out and blamed the yield curve on the Fed.
Yeah.
We know the president loves to blame the Fed for things. It's been his pattern recently. Any truth to that at all?
No. No.
Any connection to what the Fed's been doing in any way?
No, not really. The president the president, when he wasn't president, wanted interest rates to be higher. He thought it was bad for people that interest rates, he wanted them to be lower. He becomes president. I'm sorry, I did it the wrong way again.
You know what happens on inversion days? We invert things.
Everything is inverted.
He
wanted rates to be higher. He gets into office and he wants them lowered. All presidents want rates lowered on their watch. So he replaces the Fed chair, Janet Yellen, with his guy, Jay Powell. Good guy, but he wants him to do his bidding. Jay Powell is saying the evidence doesn't support lowering interest rates right now, but he did because the president badgered him into it, and he wants Jay Powell to do it more. Here's the danger. As you and I discussed last time, interest rates are the fuel in the tank. If you get into a recession, you want to be able to lower interest rates to stimulate the economy. If you lower all the interest rates before the recession, and then you get into a recession, this happened to Japan, you can get stuck in this recession for a very long time.
I think the one question people may be watching this and thinking is, well, then what do I do? How do I go forward if I'm not sure if we're going to have a recession? What is the smartest way to just kind of handle your finances and yourself in the next 6 months?
So I want to remind people that the thing they have to take most seriously is their income. Right? Their job is more serious than the stock market, generally speaking. But the stock market is your savings. If you get out of the market and you don't know when to get back in, you can miss maybe the 5 best days in the stock market and all your gains for the year are gone. So it is hard to tell people to get in and out of the market. I would say this. It's not something a lot of people do. You should go in and make sure that your portfolio is balanced according to your risk tolerance. You can take these surveys all over the web. Just type in risk tolerance. Find out what pieces of the pie your investment should be in, and just make sure you match that. Redo that every 3 months. If you haven't done it in the last 6 months or a year, do it now. That's the best thing you can do for now. If the signals change a lot and we look like we're really headed for, terror, I'll come and tell you.
Ali, and the one thing we always tell people, I'm sure they hate to hear it, is just breathe, right? As much as these corrections don't feel good, they are natural and they are necessities.
And particularly in TV and in business TV, this is what we do, right? We tell people about all of these little moves. It's not necessarily always important for everybody to know this. I will say this. I treat this inversion of the yield curve like a tornado warning. It doesn't say one's coming. It says the preconditions exist for one, so you should take necessary precautions.
I love this. Ali Velshi bringing weather in the markets together. I appreciate it. Thanks for joining us.
Hey, NBC News viewers, thanks for checking out our YouTube channel. Subscribe by clicking on that button down here, and click on any of the videos over here to watch the latest interviews, show highlights, and digital exclusives. Thanks for watching.